Good evening, everyone, and welcome to the Pensions Committee and Board meeting. A very belated Happy New Year. I'm not sure if I'm still allowed to say that actually, but Happy New Year anyway. So just so you're all aware, there will be filming at the meeting. This meeting is being recorded. All registered speakers should be aware that they will be recorded for live or subsequent broadcasts via the council's internet site or by anyone attending the meeting. So we have received apologies from Ishmael and Craig, and for item 3, there is currently no urgent business. Moving on to item 4 for declaration of interest. Do any members have a declaration of interest? Councillor Bevan?
I will be submitting my training list to the Democratic Services this week.
Thank you, Councillor Bevan. Is there anyone else with any declarations of interest? No? Sure. So moving on, item 5, there's no deputations for tonight. Item 6, record of any training undertaken since the last meeting. Is there any training taken since the last meeting?
Tim, I don't know if you have a record of Craig and I went to one of those lab programs. I can't remember exactly which one. Maybe I'll send you an email. It was one of the day courses that both of us went to, I think, before Christmas. Thanks.
Thank you. Is there anything else to record?
Yes, I'll just mention that there was training just before tonight to one of the items that's going to be considered in the exam part of the meeting.
Brilliant. Thank you. Moving on to the minutes. I believe the minutes were sent. I'll take it as read. Is there any comments around the minutes that were sent? Councillor Bevan?
Yeah, I've got a couple of comments on the minutes, especially the first minutes that are so old now. It's just unbelievable. But in those minutes, we do mention having the London SIB here. And I know we've discussed it since, but this has been ongoing since July. It was first recorded and we still haven't got them here. And then the second point is, do we know if any members attended the LGA sessions on the local government pension fund? So that's my 2 points about the first minutes.
Would you like to reply, Tim?
Yeah, so I think on the second point, I understand that Councillor Tay and Craig and Councillor White attended the LGA training, which was offered to members. Regarding the London SIV, yes, we're happy to invite them. I think we've had that discussion and I noticed the lateness in action in that item.
In the second minutes, it mentioned a self-service portal, which I think is a good idea for us to see it on the screen and how it works. I know it's not on the agenda. I know you sent out a link to it. The link doesn't work. I tried it this afternoon. It doesn't connect to the system. So personally, I think we should have an agenda item on the next meeting that you get that self-service portal on the screen. We can all see how it all works for Haringey employers when they access it, if you agree, Chair.
Jamie, do you have a response to that? Or are you happy to?
Yep, happy to have that in the next meeting if that's okay, Chair.
Yeah, brilliant. Thank you.
If I may, I will just mention that so showing that particular app might not be good for the meeting in terms of some of the information that's considered on it. It might be exempt or rather confidential arrangements of pensions individuals. But we are happy to arrange a workshop for members to talk through that. Jamie and his team do this regularly for members of staff when we're onboarding them. And he'll be happy to extend that to all the members. So we'll send an invite, and if that can be noted as an action, we'll do that as soon as possible.
Can we agree that that action is to be taken? Yeah, agreed. Agreed. And is there anything else on the minutes, or are the minutes agreed? Agreed. Brilliant. Thank you. So moving on to item 8. I believe that's you, Jamie.
Great, thank you, Chair. I'll be presenting the pension administration update. There's 5 items to be updated on today: the pension fund membership update, the online member self-service portal update, the update on the McLeod project, the update on service level agreements, SLA statistics, and an update on the recruitment. So the first update is on the membership. So as you can see, there's not much change in the membership numbers from September to December. So all the figures are as at the 31st of December. The key change would mainly be the deferred members have gone down a bit, and that's due to members retiring or transferring out of the Haringey Fund. Moving on to the online member self-service portal update. So in table 0.6.4, the table shows the total active members in a scheme and the members who sign up to MSS. As you can see, it's still gone up every quarter, so now up to 21.06% of members who are registered with the member self-service portal. In item 6.5, it shows how recently the members have accessed the portal. So within the last 7 days, it's 43 members, all the way up to the last 3 months being 362, and those totals are cumulative. So moving on to the McLeod Remedy project. So we've previously advised the PCB about the McLeod case and the outcome, and the arrangements that the pensions fund team are making to rectify that. On the November the 15th, the Local Government Association, LGA, released their first instalment of the McLeod Technical Guide, and this basically explains how the protection may be applied within the LGPS. It's part 1 of a 3-part guide, and we're waiting for the other 2 instalments, and they said they'll be released early 2024. So we've got the guide, and we're working through that to understand how that guidance impacts our current ongoing project, and any finding of material significance will let the pension committee board know. So we're still working with our pension administration software provider, Haywoods, to work through the project. So we've got the initial data load into the test environment. We did have a few data validation issues, which we've now corrected, and we've done the initial load into the live environment. Once we've done that load and we've done the validation for the data, we can then do the eligibility run, and that'll give us the list of members who are potentially within the catchment for the McLeod project. So that's kind of the next step. So as always, we anticipate that the actual implementation of the remedy will be complex and time consuming, and we do envision there may be additional resources required, and we'll let the BCB know if that is the case. And we'll keep updating the pension board committee on any updates in regards to McLeod. And I'll take any questions on that now.
Councillor Bevan?
Yeah, on page 4, you've got the performance figures for the various service level agreements, which I don't think we've seen them before, to my recollection. And then on the previous page, you say about aligning the service level agreements with the SIPFA new procedures. So I take it that's an action that our service level agreement performance figures are aligned with SIPFA, or will be. And then I think we should have these service level performance figures, whether we have them twice a year or every meeting. I'm open, but I think we should get those performance figures on a regular basis.
Yes, agreed. So we will be providing them every meeting. And correct. So at the moment, the SLA figures we've quoted in there are the ones we have agreed in the administration strategy. SIPFA ones are slightly different, and we haven't got that in our kind of extract yet. So we're working towards that to have both sets in the next pack.
Another point, it mentions 2 apprenticeships. Have they been? I know you mentioned before we got 1. Is this another 2, or is this one we had before? Is he one of the 2, or one's a graduate and 2 are these different? So can you just explain that?
So we will, but we'll get to that part a bit later. So I'll talk to the SLAs, and then I'll get to the recruitments bit at the end, and I'll answer your question. Any more questions on McLeod, and then I'll move on. So moving on to the service level agreements, as pointed out, is a new section in the administration update, and we will be having it in each report updating. So service level agreements, are SLAs, are basically what the fund details how quickly they're going to process the casework. So in the administration strategy, it outlines how quickly, for example, a change of address will be done, a retirement will be processed, and you can measure that, your performance against that. So SIPFA do have benchmarking processes that we haven't benchmarked to just yet, but we're looking to update the kind of parameters. So next time we'll be benchmarked against SIPFA, which will allow us to kind of compare ourselves to other LG funds more kind of easier. So the table in 6.16 shows how we're currently performing. So I would say a good SLA would be above 90%. And as you can see, we're falling a bit short on some of those targets. And that's mainly due to, as you're aware, the kind of pension team have been recruiting quite heavily in the last year. So onboarding new members of the team and getting them up to speed has taken time. So I would envision that over the next months, those figures will improve. But yeah, that's any questions on the SLAs? Okay. And lastly, an update on recruitment. So as Councillor Bevan did point out, we've been waiting for an apprentice for a little while. And because when we advertised and done the interviews, we were very impressed, and we actually created 2 posts instead of 1. So we now have 2 apprentices who actually started on Monday. So they're now in a team, and the good thing about this, it gives us time to kind of build resilience within the team and support effective kind of succession planning within the team. And yeah, that's it for the
Councillor Ngara.
So can I ask the apprentice that you've recruited, where have they come from? Are they local?
Yeah, so good point. I should have mentioned they are local to Haringey.
Councillor Hymas.
And just to kind of confirm, when you say the structure has been amended, that hasn't involved the removal of other posts, and then the apprentices like replacing that. It's been in addition to the existing team, because I know that there had been vacancies in the not too recent past.
Yes, I think yeah, Councillor Bevan did raise this because the request for an apprentice came from this committee and board some years back, I think before I joined. So when Jamie came, one of the key tasks we had was to make sure that there's an apprentice post in the team. So it didn't actually exist. So we had to work with our HR team, who have then created a post. But as Jamie went through the recruitment process, we're very impressed with the candidate that came across. So instead of just having 1, we actually went back to HR and asked if we could have an additional post for an apprentice, and we got 2 of them. So they are on a structured training plan. I believe it's going to take 18 to 24 months. And by then we hope that they'll be fully fledged pension officers and be able to continue to grow their career. So yeah, it's a quite good success story, but yeah, the existing team says the same. This is in addition to.
Thank you very much for that. And I guess on behalf of the board and committee, I'd like to congratulate both the apprentices and have that noted down as well. So moving on to item 9, Tim, I believe you want.
Yes, thank you, Chair. So I'll just make a brief introduction of this particular item. Members will note that at the last meeting in September, we did bring forward a paper recommending, so discussing the consultation that the government had at the time on the next steps in local government pension investments. So we had a draft response, which we did submit before the deadline on the 2nd of October. To our surprise, the government was relatively quick in their response. So by the 22nd of November, they had produced a response based on the initial consultation that they'd consulted on. So our independent advisor has taken time to go through that response, and he's prepared a paper that he can sort of talk through around the key highlights from what the government has come back with from the consultation.
Thank you. Yes, John.
Thanks, Chair. Yeah, my paper basically goes through the outcome to the consultation which the government issued on the 22nd of November. I mean, Tim's right. Closes on the 2nd of October. We get a response on the 22nd of November. It's very interesting. I'll compare that with the consultation that closed in November 2022 on climate change reporting. A rather important issue, I think everyone would agree. We haven't had a consultation outcome yet from that. So November 2022, we're now sitting in January 2024, no response. However, on this one, and I had 152 responses, remember, to this, And I know ours was about a dozen pages long, and I know 2 other funds that I deal with in London both submitted responses about a dozen pages long or thereabouts. So they had an awful lot to read, but they got it back very quickly. I won't speculate as to why they've done that, but they have. So just to sort of move on and talk about this a little bit. You'll recall in September we talked about this, and there were 5 big issues in the consultation. By far the biggest one was the issue of asset pooling and governance reporting, but there were also some interesting proposals regarding government's levelling up agenda, private equity, investment consultancy services to the LGPS, and there was also a technical change in the definition of investments. Asset pooling was the really big one, because we've been waiting for this since 2019, when the government did issue a consultation and then hastily withdrew it. I think the really interesting thing is how they've come back, because what they've done is, despite the fact that there was quite a lot of well, opposition, certainly, and an awful lot of, I think, questioning about the proposals, they've essentially come back and said, we're going to go ahead with this in the main. That's the headline. But if you actually look at what they've said in the response, they have nuanced a lot of things. So they want things done, but actually, in essence, it's voluntary. And the reason for that, and to be fair, in the consultation outcome that they basically say is fiduciary duty. That ultimately they do not have the authority to order this committee and board or the committee of any other LGPS to do specific things. So if we go to look at the various issues in detail, and that's on page 13, it started the consultation outcome. One of the big issues was that they wanted all listed assets and all unlisted assets, all assets transferred from funds to pools by March 2025. That they've maintained that. However, they have nuanced it rather, I think, appropriately and very clearly, because what they've said is that funds have to transition assets by March 2025 or set out a response. This is effectively a comply or explain regime. So yes, we would like you to do it. I'm sure myself more funds will transition more, but you do not have to do it. And if you don't, you have to explain. And they also say that the regime does not mandate particular investment choices. And I think that word's quite important. What it means is, if you want to do it by 2025, do it. We'd like you to do it. And if you don't, explain it, and that's your right. So I think that's where they are. So they've got a clear agenda. They want us to go in a particular direction. I'm sure there'll be more pooled, but you're not forced to. So that's quite important. They've also made a number of other statements. Clearly, this is going to strengthen pooling, and I think there will be a move towards more pooling. There's no doubt whatsoever about that. And that's clear on paragraph 49. They will revise the guidance on pooling. It will set a clear direction for all funds to move towards the delegation of strategy implementation and manager selection. So what they're basically saying is, we want managers selected by the pools going forward. But again, notice the word guidance. Now, they haven't been more specific. We'll have to wait to see what the guidance is, but I suspect, again, this will not be absolutely mandatory. Paragraph 50 is interesting. Revised guidance will include a preferred model of pooling, but it will be based on characteristics and outcomes rather than particular structures. I think this goes back to 2019, when the very big northern funds objected to an idea they had then that pools had to be FCA regulated. And they said, no, we don't think that's right. And I think what's happened now is they've said, we'll lay out some guidelines, but it's more about your intent than the form. There was also quite an interesting thing there. They've actually talked about funds still having control of their pools, which is quite, I think, significant, actually. They've stated that control should lie with the funds and that pools should be providing what the funds want. Statement of the obvious, statement of logic, but again, I think it does stress the importance of funds, which is helpful to see the government hasn't sort of completely gone down sort of pool approach and are forgetting that it's the funds who are mentioned in the regulations, not the pools. The pools are there to, implement and help the funds. They have said that pools can provide investment advice to funds. There was a lot of objections to that. People have talked about conflicts of interest, and I personally sympathise with that. I think, if you're setting out investment strategy and then implementing it, there's a bit of a circular argument there. But there's no compulsion to do it, and I suspect many funds will continue with their traditional approaches. One quite important change, which certainly strengthens funds, not this one, of course, because we're already subject to it, but there's no requirement, as you know, for pension committee members to have training. If it's for pension board members, which is very logical because boards are governance bodies, they don't have decision-making powers, committees have decision-making powers. So in 84 of the 86 LGPSs, you have this split between a pension board and a committee, and we don't here. So you're a board and a committee, so you're already required to have statutory obligation. But everywhere else it doesn't apply, except Hampshire. They're bringing that in, which I think again will strengthen the funds. So although there's a move towards pooling, the government having interestingly beefed up certain elements with regard to the fund, which is quite interesting. Just to move on also, there was talk in the original consultation about reducing the number of pools. The government are not going to do that. They've said we don't want to do that in the short term. But what they have made clear is they'd like to consolidate more assets into pools and then eventually reduce the number. But I suspect that's going to be several years away. But that's certainly the intention. Turning to the other things, levelling up. What they've come back and said is, in the consultation, they said we'd like you to invest 5% of your funds in levelling up agenda. What they've said is we'd like you to do that, but, and I quote, the government's view is that the requirement to set a plan does not mandate investment and does not cut across fiduciary duty. So they're basically, pushing away any challenges because they're saying this is purely voluntary. It's the same with private equity. So they're setting an ambition to invest 5 and 10%, but they say it would not mandate investment. Administration authorities would not be required to do so. They're under the same requirements as currently to act in the interest of members under their fiduciary duty. So again, it's an exhortation, but no requirement. There was a suggestion in response to investment consultancy services saying that funds should set objectives to them, quite logical. But there was an exemption in the original consultation, and that exemption was that if pools provided advice, they didn't need to have objectives set for them. Well, they've reversed that now because lots of people came back and said, well, that's not logical, is it? And they've accepted that. So they've reversed that one. So that's basically, I think what they're going to do here, and it's quite clear, they want to strengthen pooling, they want to accelerate pooling, but they've stressed there's a comply and explain regime. They've also stated quite categorically that pools are required, and I quote, to act in the best interest of funds. And while they've not mandated investment in levelling up or private equity, they've exhorted it. So I think what they've done is they've pushed their agenda as far as they can, but they've certainly not led themselves open to any challenge because they've been, I think, clearer than I expected, certainly in this idea of fiduciary duty. That's all I've really got to say. Happy to take any questions or comments.
Councillor Lagarde.
Just a quick one, John. Do you think we have to do anything different from what we're doing now? Because from what I see, we seem to be doing most of this anyway.
I think you're doing exactly what you're required to do under this. It's an exhortation to pooling. Where pooling has suited this fund, we've pooled. And it has most other funds have done. I mean, there are very few, I think, funds who have set themselves against pooling on principle. I think most people are taking a logical and sensible approach, which is where the pool provides an advantage, it's used. If the pool doesn't provide an advantage, it isn't used. But for the majority of assets, I think for the majority of funds in London, they've got the majority under pool already. So I don't think the government are pushing a closed door. But it has to be when it suits the interest of this fund. That's fiduciary duty, and they've acknowledged it, to be fair to them.
Councillor White.
Thanks. Do we have investments of in assets that would be considered by this to support levelling up, or if not, do we have an explanation ready?
I mean, you could argue some of them. I mean, if I think of infrastructure debt, for example, that's one, because that's got the Ring Road in Aberdeen, which I'm sure supported the economy of Aberdeen. It's got the M6 toll road, which I think was a major boost to trying to get traffic up and down through the area where I grew up. Port of Dover, redevelopment of that. Anybody who's been down to Dover sees half of it is out. Dover's an area I think that probably is an area that needs levelling up. So that particular investment, I know it's not a huge one, but that's certainly a levelling up investment, very much so. But by accident, it was long before levelling up was thought of, but that's a definite one. The whole infrastructure debt with Howling wants.
I think the London Fund as well,
Yeah.
with the London SIB, I think would definitely fit.
Councillor Hymas?
Yeah, my question is, you mentioned in the report that you think it could be like statutory guidance that the government issue around this. Obviously, that carries the kind of legal weight of it must be followed like due regard effectively. Do you think that it would be through statutory guidance and then it would have that level of weight where we'd have to show good reason not to comply? Or do you think it would be more likely be statutory guidance saying that you must explain if you're not going to follow it, if you catch my drift?
Yeah, that's a very good one, because you're right about statutory guidance. And thinking in the classic examples of education, social services, you follow it unless you've good reason not to. You'll have to follow this statutory guidance exactly the same way. But we've got the overlay of fiduciary duty. And I think, I mean, I'll give way to Patrick on this one, but I think the fiduciary duty as a concept in law will be higher than their statutory guidance, and their statutory guidance can't override fiduciary duty. And I think that's the issue. And I think that's why they've been very careful here, that the guidance they produce, for example, there will be statutory guidance on levelling up and investment in private equity, but it will be very much on this basis of you don't have to do it if you don't think it's in your own best interests. So you're absolutely right. I have to follow statutory guidance unless we have good reason not to, just as you would, in the sort of social service or education context. But we've got this overriding fiduciary duty, all sort of encompassing. So I think that's the difference, is that we've got something else there. So no, I mean, there'll be no compulsion to do anything really in terms of levelling up or private equity or even pooling. Because ultimately it's you, that's the overriding thing, is it's the committee that has the fiduciary duty, not them.
But when you say comply or explain, the explain would be laying out why not doing that would be in our fiduciary duty.
Yeah,
And
yeah.
how would that be laid out? Would that need to be like a formal kind of minuted action in a meeting, or would it be a letter from the head of pensions to the government? Like what would that look like, do you think? Or is that speculation?
We don't know until they issue it. But it's very interesting what they've said, where they said, and I'll quote it again, which I thought was interesting, and I didn't expect it. I suspect a lot of people didn't. Was where they said, this is effectively a comply or explain regime which does not mandate particular investment choices. So yes, you're going to have to explain, but it doesn't sound like they're going to put the guidance in such a way that they're going to tie your hands behind your back, because I don't think they could. So we don't know what the form will be, but clearly if people have a reason why they don't believe it's appropriate to pool, they won't have to. I mean, pooling is there to assist the fund to achieve its objectives, which is to pay pensions. If something in pooling, if you had a pooling investment which didn't help you, which went again, was worse than what you had already, then it would be against your fiduciary duty, in simple terms, to do it. So they can't force you to do something which you consider to be not appropriate. And if you explain it, do you know what? If you explain it well, who's going to challenge it? They're not going to come along to 86 funds and challenge it all. But they know that lots of people will just comply. And I think that's what they're at. What they're doing here is they're trying to get people to take the easy route and just, if it's a marginal decision, they'll push it over into the pool. And I think that's what they're looking for, to be honest.
Just quickly, I think, Tim, did you want to comment on this point?
Yes, I was just going to come on both points, and I think the one that Councillor White made as well in relation to leveling up. So firstly, in terms of how that could be set out, I think on some of the proposals, I'm not sure on the outcomes, but in the consultation, they did say set it out in the investment strategy. So where we set our asset allocation, we would just say we are not able to allocate to this particular asset class for this reason. It could be it doesn't meet our risk requirements. It could be we can't access it, we don't have the expertise, anything of that nature could be set out. But like John says, it's not been, would wait for the statutory guidance, which would then outline how exactly that would be set out. But that's one, for example, especially with leveling up, I think the consultation said you must set 5% within your investment strategy. So I'd imagine if you're not able to achieve that, you'd have to articulate that within the investment strategy itself. More on that broader point, so I think John made a really good point in terms of the infrastructure debt, because I think that's one that many people don't initially consider being a leveling up investment, but it does meet the criteria because the government in their white paper set out 6 capitals of what would consider a leveling up investment, and that's infrastructure debt within the UK. I believe our allocation to that is around 2.5%. The London fund is around 3%. So on that threshold, we do already have 5%. But we also have property funds that are 15.5% or whatever. So when this was initially suggested as a requirement, I think the main confusion we sort of had is how would you actually classify the investments you already have? Because in our view, most of those investments are way beyond the 5%. It's just we don't label them leveling up. And I mean, the intention of going into those investments was more for our investment strategy rather than necessarily outlining that this was to achieve the leveling up objective. So I just wanted to clarify on those 2 points, but I don't think that's something we'd have to state that we're not able to comply with.
Councillor White, then Councillor Bevan.
Thanks. I was just going to ask if we're anticipating that there are going to be any penalties for the explanation not being good enough. If we're talking about comply or explain, is there going to be somebody like, in the ministry having a look at the explanations and judging whether they're adequate?
I think the ministry have got so few civil servants working on LGPS that they haven't actually issued, for example, a consultation outcome for climate change, which is, I would regard as one of the absolute top priorities that they should have responded to. So I think the answer is, I'd be very surprised if they had the resources to do it. But the truth is, I think most LGPS funds who do explain will explain it well, to be honest. I think the one thing about local government is that committee reports, officer work tends to be pretty good. And so therefore, I doubt anyone's going to write anything bad. But even if the government did want to, the resources allocated by, DLUC to LGPS are not huge, to say the least.
I was just going to say, one would argue that if they can penalize you for not complying, then they are mandating you to do something. So I think that's probably something the government will look on very carefully.
Councillor Bevan, then we'll go to Councillor Harris.
What happened to the idea that was floating about that you could invest in another pool if they had an investment that suited you perfectly and the London Civ didn't?
I think they've come back and this idea that your pool can deal with another pool, but you can't do it directly. So, and that's already happened. The London Fund essentially is an LPP investment. I mean, what's happened with the London Fund is that the London Civ basically have come to an arrangement with the LPP who, are the pool for Lancashire, LPFA and Berkshire, and have allowed access to the London boroughs to it. So I think it's the same position effectively, but Haringey can't, for example, go directly to LPP or to Brunel. But if the London Civ comes to an arrangement, and that is being said in the response, they are saying that they expect there to be more interpool collaboration. But of course, that they are hoping is the easy way to incorporation and mergers in the long term. What they're hoping for, I think, and it is in a consultation response, it's a very good question, actually, Councillor Bevan, is that there'll be more of it. We've seen it already between London Civ and LPP on London Fund. We're seeing it between LPP and Northern on GLIL. So yes, I think it is allowed, and I'm emphasising it more. But we can't go directly to another pool But of course, we could go directly to, to an individual asset manager. That's the strange thing. You can't go to a pool, but you can go to an asset manager direct. But yeah, that's the position.
Councillor Hymas.
Yeah, I guess it's more of a kind of point. But it does feel incredibly contradictory that on the one hand, they say we want more training for pension fund members, which we obviously would support. And then on the other hand, say we want them to be trained to do less, to make less decisions, to be less responsible, for us to mandate a lot more in terms of the government speaking, to mandate a lot more of what we do. And I think it reminds me again of the Economic Activity of Public Bodies Bill as well, which is again seems to ride roughshod over the fiduciary duty, instead using the government to compel certain kind of political agendas onto local authorities and us as members who have been democratically representing our pension fund and representing the membership of that. So I think it's incredibly concerning to me that the government seems to have so little regard to what we do on this committee and our kind of elected responsibilities. So yeah, I just want that to be recorded because it's incredibly frustrating that they keep doing this.
I just had a quick question as well. So obviously I'm relatively new to this committee, but it seems as though there's a lot of things happening in the pensions world and a lot of restrictions, as well as just a lot of uncertainty. Is this usual for the pensions world, or is it something that's are we in a turbulent time really?
I think this is a very unusual consultation. Let's look at a few other consultations. There was a consultation on fair deal that essentially relates to when people are transferred out of the LGPS into private contractors. That's been running, and Jamie will probably correct me on this, for about 4 or 5 years, I think, and particularly into the fact of, the pension admin side. And there's still no resolution to that. And the first, I think, consultation was 4 or 5 years ago. We had the consultation on climate change. I'd have thought, rather important to, closed 2022, no response yet. We're waiting for a consultation on good governance, which I think was the most significant piece of work the Scheme Advisory Board has done. Huge potential benefits, much of which have been done by individual funds, but it's not compulsory. 2021, that went in, no consultation. This, we waited for 4 years. It came out 4 years later, and suddenly we've got a response within a few weeks. I think the answer is that this isn't LGPS which is speaking to us. This all has to do with the government's agenda to do with what they think pensions can do, because all of this, of course, is wrapped up with the statement, and I'm not being in any way political here, the statements that the Chancellor of the Exchequer made about pension funds being used, and this is in the DC world, defined contribution, defined benefit, LGPS, being used for, various activities in the United Kingdom. And I suspect that this response was produced very quickly because this is a particular interest of government at large rather than LGPS. So I think that's why this is all out and out pretty quickly. I think, it's pretty obvious why it is, because why has climate change not been come back to us? I don't understand why it hasn't. I can't answer why, but I was just fascinated this came back in a couple of months, and climate change, we've waited, what is it now? 14 months and we've not had a response. Anyway, it's just my thoughts.
Thank you very much for that, John. So move on to item 10, which is the Local Authority Pension Fund Forum update. Sorry. So Tim.
Yes, thank you, Chair. So yeah, again, just a brief introduction for this particular report. It is a report we bring to this committee on a quarterly basis, just outlining the activities of LAPF. LAPF are an organization that engages with companies directly, and the fund, through its membership, gets some input into the work that LAPF puts across. So in the report, we summarize the engagement efforts of LAPF. I do apologize that this goes back to September. We haven't got the latest December figures ready yet. But most of the engagement was with companies, I think 182 companies across 10 jurisdictions. primarily on a LAP initiative that they call Climate Nature Action 100. So this is just trying to encourage those companies to have a plan in place as to how their businesses become more environmentally friendly. So LAPFOOD have gone through a process of identifying the main companies where they think they can have the greatest impact, and then they'll go ahead and engage with them. The engagement itself is an early part where they send a letter. This is usually a letter where they're outlining their views and inviting to meet with management. That's then followed by other forms of engagement, such as meetings and issuing voting alerts, which takes us to section 6.4. There weren't many voting alerts during the period, just the two. One which was for Ryanair, which again, that was for a management resolution on their remuneration policy. So nothing related to the climate, but again, shows the outcome of that particular report in that section. So yeah, those are the key things I just wanted to highlight. But yeah, happy to open up to questions, Chair.
Councillor Bevan.
I'm just asking because LAP every year asks for our investment holdings so that they can amalgamate the whole local government pension scheme over the UK. They get some idea of where the whole schemes have a big holding and therefore more influence. Did we manage to send our holdings figures to?
Yes, so I remember receiving that, but I would have to confirm on whether we actually did respond to it. So yeah, the team do tend to respond to these on an annual basis. I don't think we've got any chaser, so I would lean on the side that we did receive it. We did return it, but I can confirm that after the meeting in terms of the submission.
If there are no other questions, I'll move on to item 11, which is the risk register. Yeah, I think that's one for you. Oh, sorry, it's one for you, Jamie. Sorry.
Chair, thank you. So I'll be presenting the Haringey Pension Fund Risk Register. So this paper is to update the Pension Committee and Board on the Pension Fund Risk Register and to provide an opportunity for the PCB to review the risk score allocation. So the pension regulator requires the pension committee to have internal controls for the pension fund to ensure that it's administered and managed in accordance with the scheme rules and legal requirements. So the pension fund risk register covers several areas, including the administration, governance, investment, accounting, funding, and legislation risks. So on to point 6.4, how the risks are scored. So it's based on two metrics. You have your potential impact of the risk and the likelihood. Both metrics are scored out of 5, 1 being the lowest and 5 being the highest. We've identified 3 key risks under section 6.5. So the first risk is high inflation. So at the moment, inflation remains higher and for a longer period than initially anticipated, and this increases the risk on the investing and funding for the pension fund. So actions that we take to kind of manage and mitigate the risk is the pension fund has several investments mandates in inflation-linked strategies, which should provide some level of protection. The second key identified risk is the delay in the publication of statement of accounts. So I'm sure the PCB are aware the council is still experiencing significant delays in the completion of the external audit of its statement of accounts. The draft accounts have been published for 21-22 and 22-23, but the external audit for both of these financial years remain outstanding. So this means that the pension fund has failed to meet its statutory requirements for not publishing audited annual reports for the past 2 years. So what we're trying to do to mitigate the risk is, since the last update to PCB from the fund's external auditors, unfortunately, very little progress had been made in completing the outstanding audit. So officers have actively been engaging with the external auditors to complete this activity. And we've also brought it to the attention of the Public Sector Audit Appointments Limited, who are responsible for the external audit appointments. And the last risk is the increasing risk of a market downturn. So the Bank of England Monetary Policy Committee, the MPC, have stated that they will take the necessary action to return inflation down to 2%. The current rate is 5.25%, and it's the highest levels we've seen since the Great Financial Crisis. It's expected that the MPC will continue to increase interest rates given the inflation is proving stickier than originally anticipated. However, this can increase the risk of recession in the UK in 2024. And what we're doing to try and mitigate that risk is officers will continue to monitor the situation as it develops and consult with the investment managers and advisors where necessary, and will make the appropriate recommendation to the pension board and committee. And the pension fund is currently conducting a thorough investigation review of an investment strategy following the actuarial valuation last year, and consider the investment risks and opportunities given the prevailing macroeconomic environment. And I will take any questions on that.
Councillor Hymas.
My question was about investment risk 3, I think you said, which was the increased scrutiny on ESG issues. I think it'd be amiss to say that there's not increased scrutiny on ESG issues tonight. I guess my question is that we talk a lot about climate in the kind of treat section and in the mitigations that we have in place. And I know that Tim had emailed earlier today specifically about Elbit and Arms Company that we have some exposure to through our MSCI fund. So I'm just wondering whether some further thought can be given to the kind of mitigations there, maybe what we can do in terms of sort of broadening that ESG kind of risk to not just climate, which is obviously a massive pressing issue that we need to address, but also some of the ethical human rights issues, which are obviously very closely interrelated to climate as well.
Yes, so yeah, thank you, Councillor Hymas. I think that's a great observation. In one of the agenda items that I think is going to be part of the exempt portion, what we set out is our investment strategy statement. And that is essentially what the committee would use in terms of what guides what investments it can and cannot invest in. In that, one of the things we've identified from the engagement we've had with members and what we're including in the proposals is that we take some time to consider the ESG approach of the fund in greater detail. As I've highlighted to members before, is these matters do require external specialists. I mean, we do have MERSA who can assist in some of that work, but we might require to appoint other people to come in as well and advise the committee on that. But it is for the committee to decide. But essentially, in terms of that ESG policy, it's a requirement of the investment strategy statement. And what we are sort of assessing that risk is based on the current policy, which will require some further consideration from members.
Councillor White.
Thanks for that, and thanks, Tim, for that response. Yeah, I just wanted to say that I agree. I think maybe we do need to put some more emphasis on other parts of ESG, not just the environmental, which I think we all agree that the climate crisis is possibly the single biggest challenge facing humanity. But I think we do need to look at the kind of the social and other ethical sides of our investments, and that is kind of left out of it a little bit. So yeah, it would be good to have a deeper conversation about that, about updating our investment strategy to reflect that. Thanks.
If there's no other questions, I have a question, and it's about audits. As you know, I like to badger on about audits, but I guess just the legal ramifications. Are we still under significant legal risk from this, or will the government now? Will the government step in and take some of the blame for what's happening here?
I think we've approached the organization to see whether or not we could appoint separate auditors. At the moment, that's not possible. So I think there's still a conversation going on between finance. I don't know what further discussion you've had with them since.
Yes, so I think this was raised at previous meetings as well as a concern, and this is why we've included it on the risk register, just to highlight it to members. I think one of the updates we've included in this particular paper is to highlight it as a national issue, as that is something that the government is well aware of. I'm not sure if members would be aware that at the back end of the previous year, the government actually set out a letter where they set out how they were planning on tackling these backlogs. Haringey is not on its own in this. This is quite widespread. I believe around 40% of audits are still outstanding across the country on public sector. So the government has set out these proposals. So in some of our engagement with auditors asking exactly that question on whether we can have a separate audit, there are two issues. The first one is we can't have a separate audit from the council. Our audit falls under the council's arrangements, and they have the auditor and they sort of audit the pension fund as well. It is slightly at odds with the regulations because they require the pensions committee and board, or the equivalent body, the administering authority, to have an audited annual report, which is nothing to do with the council's statement of accounts. So the Scheme Advisory Board is working with the government to see whether that can be separated out. But as Patrick has pointed out, at the moment in time, it's not possible. Secondly, the process of appointing an auditor actually is done by an organization I think we've referenced here called the PSSA. I'll just reference that the Director of Finance has written to the PSSA asking them about the progress being made with this audit. He's also written to the BDO partner, senior partner, and we've been trying to engage with them quite regularly, but that's not been progressing in the way that we would like. One of the key issues that seems to be getting identified, and I'm not 100% sure on this, so just bear with, is effectively the audits are waiting to see what the government will decide to do, the audit firms will decide to do in terms of tackling the backlogs. So there is reluctance even to take on existing backlog. We do have a new incoming auditor that we've started to engage with on the current financial year that ends on the 31st of March. They will be coming in and starting a new audit, and they're doing their planning work. We have highlighted this to them as an issue. They have said to us that they'll wait until they find out what's happening with that situation. So I think it is at a point where we are trying as much as we can to progress it, but unfortunately, the way that the rules are set out, there's not much more that we can do to progress the issue. Maybe I'll let Councillor come in.
Two quick points, Tim, two questions. The first one is about audits. Correct me if I'm wrong, but this audit is paid by the pension fund, right? Which is different from the council-wide audit. So if that's the case, why doesn't this commit? I mean, why can we not separate the two out? Is my first point. The second is just a specific risk here. INV6, which is the fund has insufficient cash available to meet pension payments when they fall due. So that one, we have changed the risk, we've reduced that risk. I assume like it's from 15, it's gone down to 10. I just feel that, I mean, obviously this is something that we've discussed in the past. Are you comfortable with that, with the current risk profile for that particular risk?
Yes, so maybe I'll start with the point on audits. So essentially, it is just the rules that are set out in terms of how local audits or local government audits are undertaken. We don't actually choose the auditor. The committee doesn't appoint them. That's appointed by that company that I saw referenced earlier. And they have their agreement. That's what we've been informed, that they have their agreement with the auditor in terms of how those audits can be completed. Given that all the auditors seem to be struggling, it does seem like this is a wider issue, just not specific to a particular auditor, but to the audit sector as a whole. And that's why I think the government is sort of looking at how best to tackle that particular issue. But yeah, we do pay for it, but we don't get to choose who our auditor are. They are sort of appointed centrally. In terms of the risk INV6 on cash, so yeah, I think you're right to point out that we did actually do a review of that in July. We did a presentation, we set out some options. One of the decisions I think from that meeting was to turn on distributions on our equities. One of the investments we'll be considering today will actually improve our cash position if the committee is minded to agree. So I think I am fairly confident that based on the analysis we've done and the observations we've done that the council's cash position, that risk remains relatively low, and we'll probably change that to a green lineup.
If there are no other questions, thank you for that, Tim. So we'll move on to item 12, which is the pension fund quarterly investment and performance update. I think that's back to you, Tim.
Thank you, Chair. Yeah, so happy to update this, to provide an update to members on this. So essentially, this is a report that members will be familiar with. It's our quarterly performance. Unfortunately, our custodian, Northern Trust, have not been able to provide us with the December figures yet. It's just a bit too early. We tend to get them around this week, actually. But what we've included this time around, given the length between the meetings, is just an update as to what the assets were like in November. So that's just for members as a supplementary information. In terms of the September performance itself, it broadly remained flat. There wasn't too much movement in terms of the assets, and the value of the market value of the pension fund was a combined close to 1.7 billion. In section 6.3, there's just some charts in terms of how that performance compares over various periods of time, from 3 years all the way to 5 years, from 3 months all the way to 5 years, and that's been outlined in those tables. In section 6.5, that's just the asset allocation for the fund. Again, members will note that there hasn't been a significant change in the asset allocation. That's broadly what we would have expected. And as a result, there's been no requirement for us to rebalance. We will be reviewing our rebalancing as it's set out in here. So in future reports, it might look slightly different, but I think that's something we can have a discussion with a little bit later. The last thing to sort of update, or maybe to make a point on, is our investments in the London Serve. That's around 76% of assets are invested within the pool, and the funding position as at the 30th of November has also been included in the confidential appendix. But I can just confirm to the committee that the funding position for the pension fund was 139% as per the actuary's latest estimates. So those were the key things to update. And again, Chair, happy to open up for any questions.
Keith.
Just to help you with those numbers, the fourth quarter was extremely good. The World Bond Index was up 3.5%. The World Equity Index was up 6.4%. So we should have some very good numbers for the fourth quarter. If not, there is something else to discuss.
Yes, I look forward to getting the December figures out.
Councillor Garland.
Yeah. Can I ask Tim, what's your take on our performance against the index? I think if you look over a 5-year period, it's not a lot of difference, but certainly over the last years, last 6 quarters, our fund is. Is this something that, you know, I know we're talking about a fund over 30 years. I just want to ask, I mean, maybe a challenging question here. What do you think? What's your take on that?
I will probably ask Mesa to help me on this one. But my general view is there are assets within the portfolio that have not performed as they would have been expected due to the changes in economic factors. I think we've pointed out index-linked gilts as primarily one of those asset classes where inflation has gone up, but interest rates have also gone up, and that capital loss value has impacted the fund quite greatly. We also do have some asset classes in there that are private markets. They're not revalued on a regular basis. So sometimes there is a lag in terms of their performance, and it's something what they call smoothing. So you might not necessarily see this impact yet. Some of those managers actually get to decide the timing in terms of when they be able to sell assets and distribute back to investors. So that plays an impact into that. The other asset class we have in there, for example, property, which hasn't performed as well, but is very difficult to sort of liquidate or move out of. It is something that still has the benefit to the portfolio. It does pay some distributions in terms of income, but it just, when you compare it to a benchmark, which, you know, the target might be +5, it's not necessarily going to perform well in an environment where the market is coming down. But I'm happy to defer to Mesa or Keith. I'm sure they have their own views on this as well.
No, I think those are all good points. Another one that I would raise is I would really caution about kind of putting too much emphasis on the total fund performance relative to the total fund benchmark. And that's because for quite a few of the asset classes that we have, they are quite difficult to benchmark, as well as being lagged in many cases, as Tim pointed out. So hidden in the appendix of the Northern Trust report, for example, it says that the benchmark for renewable energy is just 8.5%. Obviously, in some market environments, that will be entirely reasonable. In some, it really won't. You know, in a period like 2022, when every asset class is down, benchmarking against an absolute 8.5% means that you're definitely going to underperform, to be honest. I mean, over very long time periods, you can certainly assess mandates against those sorts of figures, but over any particular time period, which is shorter, I think you have to be really careful. It's an inexact science, and one that's actually quite challenging. So I think it's probably easier to look at individual mandates and assess how they've done as opposed to total fund versus total benchmark.
Yeah, Keith, do you have anything to add?
Thank you for that question. I've been wanting to talk about this for a long time. That index we've created is totally artificial, and in my view, totally pointless. Because it's just taking the asset allocation that we have and applying the numbers that have occurred in the assets. So there's no measure. It's only saying what you should expect is our performance to be in line. It's exactly like marking your own homework. What it doesn't say is whether what deviations you've made from simple things is right or wrong. Ignore all short-term numbers, and then you avoid the problem that Alex is talking about. I only really look at rolling 3-5-year numbers. I mean, now if you look at that, our 3-year number is 5.03 at September. The index, our index, as comprised, reflecting exactly where we're investing, is 4.97. Pretty much the same over 5 years, 4.66 against 5.4, down slightly, but that's not really the important thing. Instead of getting the 5.3, why weren't we, for example, if we'd have been entirely in equity, as John has been advising us to be doing for years, our 3-year number would be 10.5. Our 5-year number would have been 8.9. What's the advantage if we've got something else in the portfolio? There must be some advantage from doing it, which could be from diversification or from yield or achieving some other purpose. And there's a lot of assets in there which don't seem to have done that at all. On the other hand, if you just looked at bonds, owning bonds or gilts would have been an absolute disaster. I mean, the average return per year in the all stocks, all gilts index is down 11.3 per year. It's down nearly 4% per year from over 5 years. So it's not simple, but it ought to be saying when we do something else, where is the value coming from? And I'm thinking that there's no point in buying, things like Rafa or for example, the property, unless you've got a distinct advantage over returns, over long-term returns. And I don't give any value for it being stable over short-term periods or getting a lower volatility from it, because we don't really care about volatility. But why are we buying these other things unless they're going to add some kind of value from them? So I'm against the index that we're using, and would rather have it on simple things of saying, so we can say, well, have we done well or not? Yeah. You can't answer those numbers. I mean, be honest with you. I mean, all those numbers, could any of you make any sense? Could you talk about where we are after looking at all those numbers?
I mean, that is some challenge. So I think what we can do is we can work on other different models and see whether we can improve this reporting. I think traditionally we've sort of used it as a means of checking whether the asset manager is delivering on their set benchmark. It doesn't necessarily then compare how the committee itself and its decisions have contributed. So I think what Keith is probably proposing is that we find a way of incorporating that. And yeah, I'm sure we can have some thoughts on that. I do have some views myself, which I can suggest.
Councillor Bevan.
Yeah, I'm confused because on page 45, the worst performing asset over 3 years. So every year it's got a minus figure, and at the 3 years it's got 16.9, and it's the worst one, and it's Elgin index linked gilts.
Oh, yeah.
So I'm a bit confused because we seem to be saying at the beginning,
The
we need to,
index linked gilts, 3 years minus 13.4 and 5 years minus 5.1. Yeah, they've been disaster. Yeah.
Sorry, Councillor, could you turn on your mic? It's just turned off.
I may have taken from
yeah,
slide.
my chart's showing 16.9 on page 45, so there's a few different charts about somewhere. So I'm just confused, basically.
So Keith, did you want to reply?
Say, how can I set out numbers so that the client can't understand what's going on? I'd produce all these numbers.
Yeah.
No, I think it's just, yeah, it's really good, robust feedback. So I would open to engage with the committee on how we can improve this reporting so it's more meaningful. Because essentially these reports, I think we can have some input into how they're designed, but it is information that's provided to the custodian and they just report based on those benchmarks that's been provided to them.
Yeah, Randy.
Based on the formula we're using, surely we have a responsibility to look at the worst performing ones and take some action.
Yeah, so I think we will be considering all the asset classes later on today. It is quite interesting actually because we do point out index-linked gilts, but because of how much they've changed in value, one, we've not had to sell those assets. It's a mark-to-mark type of loss, and it actually makes them more attractive at this point in the cycle. So that might be something worth discussing again. Just because we've lost that value, it's not something that we've actually sold those index-linked gilts and realized that value. It's sort of an accounting value. But then again, where we are in the cycle with the rates where they are, with the inflation where it is, this asset class may actually be more attractive, especially given it's inflation linked and how it behaves with the liability as well. So that's something we can discuss in a bit more detail. But by all means, you know, these, if a fund is underperforming, then yes, you have to review and assess and whether you see whether you're going the right course.
Yeah, go for it, Keith.
To say something else, you got two levels to look at. First of all, the big strategic asset allocation. So if you're saying, what is the return from equity? What's the return from RAFA as opposed to the World Equity Index? What's opposed to any other in that class? When you then need to drill down to at an individual manager, you now want a more specific index. So if, for example, you had a European equity manager and a US equity manager, you got the overall number, and now you're looking to say, well, how have they done in the space that they operate in? Now you look at a lower level index, how have European equity done? But we don't do that because we've got, and I don't even know why we've got in the passive, why do we just don't have one world index thing? Because otherwise we're having to deal with reallocating from assets. Which seems pointless to me. You might as well just own the world equity index and just let the match in this, which is reflecting the capitalization. Then all the adjustments will occur automatically. It's only on the other kinds of assets we see how are they doing specifically. But essentially, always the question is, have they added some value to what we're doing via an index return? And it doesn't have to be performance. It can be diversification, or it can be yield, or it can be other things. But there's got to be a positive reason why we're using those rather than the cheap passive alternative.
Councillor Lingard.
Could I ask maybe John yourselves? Could we set? I mean, we're using a benchmark which is already set for us, but could we not set our own benchmark? Could we not set a say like, look, actually, this is what we want our fund to perform, and then base it on the threshold that we set rather than someone else arbitrary sets. Also, we take in someone else's benchmark.
Yes, you definitely can. So Northern Trust have not imposed this benchmark on you. It was something that would have been updated historically, reflecting the sort of assets that you invest in and targets for each of those portfolios, but there would be nothing stopping you from deciding that you're not getting lots of value from what they're doing at the moment and you wanted to change the nature of that benchmark. Perhaps one to look into.
Did you? I don't think.
Yes, I didn't know if there were other questions, but I'm just mindful, Chair, that there has been a lot of feedback that's been given. Are there any specific actions that the committee is asking officers, advisors to look into to progress this? I do note that this is not the first time this feedback has been provided. So that would be great help in terms of how we can provide additional support to this committee.
I guess not. I guess one thing I'd be probably interested in, might be good to hear from Mercer, is I guess we heard a lot about private debt at the start, and then partway through it seemed as not as good as an investment. But I just wanted to know where that's at and if it's still something that we should be looking into, and if there's if just we could have sight of maybe other asset classes. It doesn't have to be today, but maybe if there could be a report of other asset classes that we look into for future investment strategies.
Yeah, just to say, private debt, I think, continues to be an asset class that we speak to sort of LGPS funds about. It's floating rate, so as interest rates have gone up, the returns have gone up as well, which is why some are seeing it as attractive. It would fit within that diversifying alternatives bucket. So I think the question would be, if we were going to look to allocate, where we would allocate that from. Seems like that's a discussion that maybe needs to be had across a range of asset classes that we allocate to. But yeah, we would be supportive of reviewing it.
Thank you. Is there any other questions for item 12? That's a Blake, yeah. Would you like to come up to the microphone?
Okay, Chair. Yeah. Okay. Thanks, Chair. Yeah, I've got a statement to read out here regarding the deputation this evening. I was disappointed to discover that the deputation to the Pensions Committee was unable to speak to you this evening due to a procedural issue. It's evident by the crowds outside this committee room that the feeling in Haringey is strong, and as elected representatives of the people of Haringey, I would urge you all to listen to those concerns. I was shocked to learn that the local government pension scheme continues to hold £4.6 billion in investments in companies which are complicit in Israel's grave breaches of international law and Palestinian rights. I'm particularly horrified to discover that the Haringey Pension Fund is implicated in the genocide of the Palestinian people through a fund that was chosen as part of our environmental strategy, the MSCI World Low Carbon Target Index Fund. A recent study by Queen Mary University of London found that emissions generated during the first 2 months of the Israel Defense Force attacks on Gaza were greater than the annual carbon footprint of more than 20 of the world's most climate vulnerable nations. We are investing in or are exposed to companies supplying weapons and military technology to the Israeli Defense Force, including Caterpillar, Lockheed Martin and Boeing. We are investing in companies that the Office of the United Nations High Commissioner for Human Rights lists as business enterprises active in Israel's illegal settlements, including Bank Hapoalim, Bank Leumi, Le Israel, Mizrahi Defohot Bank, Motorola, Booking.com and Airbnb. Perhaps most disturbing of all, we are investing the pension fund of our Haringey Council workers in Elbit, a weapons manufacturer that has been internationally condemned for human rights abuses, including its association with the production of cluster munitions. I would like to know what actions this committee has taken to divest Haringey pension funds away from weapon manufacturers complicit in the current genocide, from companies supplying military technology to the IDF, and companies complicit in Israel's illegal occupation across Palestine, including the illegal settlements in the West Bank. Thank you.
Thank you, Councillor Blake. If you wouldn't mind, I'll take this question first, and I guess you can add on to it. But I guess I'm a little bit unsure about the 4.6 million figure, and I guess that's something we can look into. But as you've heard from today, we're looking into our ESG strategy, and we'll look into that. We're planning on speaking about this and looking into the fund more specifically. But what you need to understand that is the pension fund is heavily restricted in a lot of the activity that it does. As you've heard today, we can't even employ our own auditor. It has to go through a company by the government. We're restricted in a lot of different ways, but we are still looking into ways that we can make it fit with Haringey values. So rest assured, we are going to be looking at, I think, in a later agenda point today, in the exempt agenda point. But I guess right now there wouldn't be, I guess, any actions that we can take. It'd be something that we have to look into and understand fully, because, you know, as you may have heard, there is a small pensions team, and there are quite a few asset classes. So we have to look into and understand outside counsel as well as legal advice before we can proceed for that. But thank you for coming along, and thank you to the members of the public coming along. We're not going to take a follow-up. We're running out of time, actually. But sorry, we're not taking a statement from. We're not taking a statement from. No. I can't. As chair of this person's causing the disturbance and interrupting the proceeding to cease, if the disturbance continues after 2 warnings in accordance with the committee order 42, I will call for a part of the room to be cleared. That, you know, we have to. This is your second warning. This is your final warning. Security, please, can you remove the member of the public interrupting the proceedings? We will pause for a meeting while the interruptions take place. Security, can you? Yeah. It's disrupting our meeting. I have to say, there are probably more supporters in this room than you think. I think disruptions are probably lessening your cause than furthering it. So if you could, your delegation will come in March. The governance process is clear, as I explained to you before. Okay, sir, could you leave the room, please? Thank you, everyone, for standing through that. We'll continue through our agenda points. So we'll head off to agenda item 13. So that is the investment strategy review and strategic asset allocation. Tim, I think that might be you.
Yes, thank you, Chair. So I think the next few items we will be considering have got appendices that are in the confidential part of the meeting. So I think we've put the report out there for the public to know what we'll be discussing, but for us to have an open discussion, I would request.
So sorry, Councillor Garner, would you mind putting
Just a point of order. I think there are people still in the meeting, external. Is this still allowed, this part of the meeting? I was just wanting to just for point of clarification.
Yeah, sure. We're not in our exempt section just yet. So yeah, they're allowed to be here.
Yeah, I think that was sort of the point I was just finishing on in terms of, we can move to the exempt parts and consider that item in particular, just because it's got a confidential appendix, which is the bulk of the discussion.
Yeah, I think we'll wait. Just I guess we're just noting this item point and then waiting, I guess, till the exempt part to have a discussion on it. Councillor White.
Yeah, thanks. Just because this is the public part of the investment strategy review, and obviously our main discussion is going to be in the exempt part, and therefore it will be minuted in the exempt minutes. So I just wanted to put in the public minutes that I would like, as I said previously under the previous item, I would like us to be looking more widely at the ESG part of the investment strategy and focusing not just on the environmental aspects, important though it is, but also the other ethical parts of our investments. And I do think that you know, obviously there are, as we can hear, there are people with some very strong opinions about what we should be doing with our investments, and I think we need to make sure that we get the message across about what we are able to do and what the what restricts us in our ability to pick and choose investments, the fact that we're invested passively, the fact that we're not invested directly in these companies but indirectly, and that if we do want to reduce our exposure to investments in certain types of companies that engage in certain types of activities that we may consider to be unethical, then it's quite a big challenge, and we can't just do it on our own, and we have to discuss, you know, obviously because of the pooling agenda and the fact that we're invested passively, so we'd need an index to invest in, and all of these kinds of things. It's very complicated, very technical, but I think we do need to find a way to communicate with people in quite a simple and easy way what the challenges are, because people are just saying sell your shares in this, sell your shares in that. It's not as simple as that. But you know, we need to engage with people that have got these agendas and show that we're doing what we can to do things in an ethical way.
Thank you, Councillor White. Yeah. Okay, amazing. If there's no other comments, I'll move on to item 14. That's the investment strategy statement. Yeah, Tim, would you say anything on that?
Yes, again, Chair, I think my remarks are the same. The previous item talks about the strategic asset allocation, which then goes into the investment strategy that will be making some recommendations to the committee today. So that discussion again is best had in the exempt part of the meeting.
Agreed. We'll move on to the next item, which is item 15. It's the forward plan. Is there any comments to be made on this?
Yes, thank you, Chair. So this particular agenda item is really to invite comments and input from members around the ongoing plan for the pension fund. So over the past year or so, I would say, the main focus has been on our investment strategy review, which I hopefully will come to sort of a close today. But there are some important actions that have been raised by members. So I think this is just an opportunity for members to assist us as officers in prioritizing, so we know what appropriate agenda items or what to include in the plan with regards to training, any agenda items that need preparation, any other people we might need to engage. So this is really what we invite to comment on this, and just also for members to note the progress that we have made over the plan for the last 12 months.
Any Councillor N'Gara?
Thanks for that, Tim. And just following on from very important points that Matt has just made. So if we come to the objectives, so 6.5, table 6.5, and setting investment objectives. I mean, we've set the term there, a thorough review of the fund's approach to responsible investment. I just wonder whether we at some point can explore that a little bit more, as what Matt said, and maybe just expand that and be very specific what we mean by responsible investment. I think that will help us navigate our strategy going forward.
Yeah, I think that's fine. We can take that forward in terms of the future work for the fund.
Is there any other questions on this item? No. Item 16, new items of urgent business. I haven't received anything, but no, there doesn't seem to be anything. So item 17, just to note the future dates of the next meeting, which is the 5th of March 2024. I'd like now to move on to the excluded part of it. So I think I need to read this part out. So items 18 to 21 are likely to be subject to a motion to exclude the press and public from the meeting as they contain exempt information as defined in section 100A of the Local Government Act 1972, as amended by section 12A of the Local Government Act 1985. Paragraph 3, namely information relating to the financial or business affairs of any particular person, including the authority holding that information. And paragraph 5, information in respect of which a claim to legal professional privilege could be maintained in legal proceedings. I'll give everyone a 5-minute break just while we accept everyone from the public. Thank you.